Financially, people can be divided into two broad categories. In one category, there will be people who will be having surplus of the money and they will be looking for the money to earn them more money by investing this money. And there will be people who will be having deficit of the money. These people will be looking for the money to efficiently run their operations, to efficiently run their lives, and they'll be ready to pay some price or premium for getting this money. There are certain services or institutions which bridge this gap between these two. They are called the financial services. Financial services basically facilitate the transactions between the people who have money and people who are in need of money. The surplus money goes to where the deficit is. Basically, today we are going to discuss about the financial services. And we'll be discussing different kind of financial services, characteristics, their classifications, and their importance. Let us imagine, let us imagine that we are in a bank. What will you see in a bank? In a bank, you will see there are a set of people who are opening their saving accounts, who are opening recurring deposit accounts, who are opening fixed deposit accounts, and bank staff is happily serving them. There will be another set of people who will be there to have some loans, home loans, vehicle loans, car loans, bike loans, working capital loans, loans for buying assets, and bank staff will be happily serving them also. What will you observe is that bank will offer a rate of interest on all the investments that it receives, and it will charge another rate of interest from all its customers who are taking loans from them. This gap will be the bank's spread and it will be building block of bank's profit. Now, if we move out of the bank and we see the stock market, you can imagine the stock market as a two-storied building. On the first story, there are the organization or the businesses who are looking to grow to their fullest potential, who are having a huge deficit, and they are ready to offer partnership to common people by offering a share in their organization in the form of IPO. And there will be people who will be looking to invest in this. There will be retail investors, wholesale investors, and all gamut of people will be there. There will be IPO managers, there will be underwriters, there will be the banks who run all the IPOs and they charge the fees from these companies which are looking to have money from these IPOs. On the second floor, what will you observe is there is a secondary market. There is a market of the shares of the companies which are already in existence. People with the surplus money will go over there and they will be buying shares from there. People will be requiring money, will be selling the shares, and they will be getting their money from there. Over here also, there are depository participants, DPs, stockbrokers, investment advisories, and all these are involved and they are getting their fees for facilitating these transactions. Now, let us move out of the stock market. Let us go to the mutual fund market. There are certain set of people who either do not have the time or do not have the expertise, or they are afraid of investing on their own, or the amount they are looking to invest is not a significant amount to make a difference in the stock market. So what these people will do is they'll invest their money into mutual funds. Mutual funds will pull the money from all such people and they will invest this money into primary and secondary market, and they will earn a profit which will be transferred to these people who have invested. Mutual fund will company will get a share on spread and they'll get their fees also. Insurance companies will more or less function the same way. They will also either take life insurance or general insurance, and they'll be having a spread, which will be their profit. Nowadays, the transactions between the organizations are not limited to a single country. The people can be in different countries of the world, and these transactions involve currencies of two different countries or a common currency which these people agree upon. And this conversion from one currency to another currency to third currency involves certain intermediaries who work in foreign exchange market. They also charge their fees for foreign exchange services. Besides, if a big corporation or a big organization is looking to have funds, they will go for either bonds, they will go for private equity, or they will go for bulk funding. All this is managed by the merchant bankers. Even the government sometimes issue the bonds and they gather the money. And in this entire operations, there is an involvement of either a bank or a merchant banker. These merchant bankers get their fees for managing the money, for gathering the money, for arranging the capital, for arranging the money also. From our discussion till now, there is a pattern. There is a pattern that you must have seen, that there are certain activities in which the customer directly gets the funds, and there are certain services in which the financial services institutions, they do not provide the funds directly to the customer, but what they do is they help customer in arranging for those funds. Hence there is a broader classification of financial services in two parts. One is fund based services. Fund based services include all kinds of loans, leasing, hire purchase, even factoring, foreign exchange transactions, wherein customer gets direct access to fund from the financial services organizations, are all called the fund based activities. Another set is fee based activities where the financial services facilitate the money. They facilitate just the services, they do not provide direct money. These services are IPO management, portfolio management, debt restructuring, even capital restructuring, credit rating services, and stock broking, a letter of credits, bank guarantees. All these are fee based services wherein the financial services provide the transaction, they provide they facilitate the transaction, and they guarantee the outcome of the transactions, and by that way they are earning a certain set of fees. On the basis of the size of the customer also, there are two broad classifications in this. One will be retail banking, where the loan goes to retail customer. It is kind of B2C kind of model. If you are taking home loan, it is retail banking. If you are taking a vehicle loan for your two wheeler, for your car, it is a retail loan. If you are taking loan for your mobile, it is also a retail service. If you are investing your money in IPO, if you are investing your money in mutual fund, if you are purchasing 100 shares of a company, all these are retail financial services. Wherein another portion is wholesale financial services, which are for the bulk arrangement of the funds, which are for the organization which runs into crores of rupees. Basically, what you will see is retail financial services are limited to fund based services only. Retail financial services have their scope limited to the fund based services only, because an individual customer would hardly require or not require fee based services. It is the wholesale financial services customers that require both services, fund based as well as fee based services. Basically, the characteristic uh, of the financial services are very simple and that have automatically emerged from our discussion. Financial services majorly facilitate the transaction between the people with the money and people who need money. The nature of financial services is very much intangible. It is not the commodities that is being traded here. Here, the trading happens of money, and that is why it is entirely an intangible transaction. Being an intangible transaction with the involvement of money, there is a market linked risk in this. Whenever you are transacting in financial services, whether you go for an IPO, there is a market related risk in it. Always the risk is associated over here. Besides, financial services are highly customer oriented. They are specifically, each financial services transaction is specifically for catering need of a customer. And that is why there is a high orientation towards the customer service. And each transaction has one specific need of the customer. And that is why these services are highly perishable in nature. Besides, these services are very dynamic because they are based on the demographics of the customer, they are based on the geography of the customer, they are based on the industry of the customer, they are based on the times, they are based on the technology. Hence, the nature of this financial services is highly dynamic and it always changes from time to time. However, the most important characteristics in the financial services is very simple. Financial services are majorly dominated by the customization of the services as per the requirement of the customer. And there is a huge focus on client service. In any financial services, the huge focus is always on client service. Ladies and gentlemen, this was regarding the financial services, where financial services become a bridge or act as a facilitator between the people who have money to spare and people who are looking to have that money. This is Amit Kumar Uparelia signing off for day. Until we meet again, thank you.